No problem. You were the earliest.
Oh, okay.
I'm going to share my...
It's okay.
I'm going to share this, and now, and now here. Perfect. Well, okay. You all see the share screen?
Yes.
Yep.
Perfect.
Yes, perfect. Let's mute our microphones.
Well, you see it, but I can't. Okay. Perfect. Well, let's talk about the scope of this presentation. We know that we have startups that are only an idea, firms with no revenues, and firms with revenues and operating margins, negative and positive. The scope of this presentation are the last two in the beginning, just to say. Before you all kill me, because I know that you are interested in the startups that are only an idea and firms with no revenues, I have to tell you that for understanding those valuations, first you need to understand the firms with revenues and operating margins, negative or positive. This is why the scope of this valuation, the presentation, is to understand that kind of valuation. To, in a second time, and understand the startups and the firms with no revenues, okay? So don't kill me, because this is going to be about first companies with revenues and operating margins. So the most important concept in finance that you need to understand any valuation is the concept of time value of money. First, I will ask you a question. If I offer you a sum of money, like $100, and you can choose between having it today or in a year, what do you prefer? If we were in an audience, I will ask that question, and I'm sure that most of you will say, I prefer it today, not in a year. And if I ask you why, what do you do with the money if you have it today? What is the difference? And you would say, you can say that you can deposit this $100 in a bank, and in a year, the bank will offer you an interest rate that could be at 10%, and in a year, you will have $110. So you know the concept of present value and future value, okay? You know it without knowing that you know that concept. So you know that 100 today is not the same than 100 in a year, because in a year, you will have 110. So what do we have? We have $100 and a 10% interest rate. So if I multiply this 100 by the interest rate that the bank gives to me, that is, I multiply it by 1 plus 10%, I obtain my 110 in a year. So 110 is a future value. And if I have a future value in a year, this 110, and I want to transform this in a present value, I have to discount this 110 by an interest rate, which is the same 10%. And what do I do with the math? Well, I just divide this 110 by 1 plus the 10%. Okay, this is very important for you to understand. If you don't understand this, you will not understand the rest of the presentation, but every valuation is based on the concept of the time value of money. So I want to make sure that all of you understand it. Do you all understand this? We are going to see it in other examples, okay? Perfect. Let's go on. Let's go on, okay. So the conclusion we have is that $1 today is preferable to $1 sometime in the future. The present value is useful in decision making, that not only for businesses, also for personal life, okay? Like the example before. So we can use this present value concept just to make the decision of buying a house today or in 10 years, to pay it today or in 10 years, to more complex corporate financial decisions, like choosing between different projects to invest. This is what you do in life. All the investors do that. Compare different companies. So we need this concept of present value. So this is like like a summary. the future value of $100 today is 110, which is the 100 times 1 plus 10%, and conversely, the present value of 110 is equal to 100 today, which is the 110 divided by the 1 plus 10%. I repeat this because it's very important for the rest of the presentation. So with this tool, we can take a present value to future and take a future value to the present. Okay, so let's go to the basis of present value. There are 3 reasons why a cash flow in the future is worth less than a similar cash flow today. The first reason is that people would have to be offered more in the future to give up present consumption. If the preference for the current consumption is strong, individuals will have to be offered much more in terms of future consumption to give up the current consumption. So the trade-off is captured by the discount rate. In the case of the example, that discount rate is 10%. So the second one is the money inflation. We know that value of currency decreases over time. Imagine in Argentina, we really know that in Argentina, we have a lot of inflation. So the greater the inflation, the greater the difference in value between a cash flow today and the same cash flow in any time of the future. And the third reason is that a promised cash flow might not be delivered for a number of reasons. Any uncertainty or risk associated with the cash flow in the future reduces the value of the cash flow. This is why it's not worth the same. So the process by which future cash flows are adjusted to reflect these factors is called discounting. And the magnitude of the factor is reflected in a discount rate. A discount rate is a composite of the expected real return, the expected inflation, and uncertainty associated with the cash flow. We are used to say that, for example, I heard in your previous webinar that some persons said that funds discount at 30% or at 40%. Well, that number it's a composite of the expected real return, the expected inflation, and all the uncertainty associated with that cash flow. So let's go on. Okay, the time value principles. Cash flows at different points in time cannot be compared or aggregated. So I cannot sum numbers, okay? I cannot sum the 100 today. If a cash flow is 100 per year, I can't sum these numbers. All cash flows have to be brought to the same point in time before the comparison and aggregations. Let's make an example. Let's assume that you own the XYZ company, and you have to choose between buying a copier of 3,500 cash or paying 1,000 per year for 5 years. What would you do? Well, you cannot aggregate the 1,000 per year. What I mean is that we can't compare the 3,500 that it costs if I download, I make one payment in cash. I can't sum the 1,000 per year. I can't say that 3,500 is comparable to 5,000, which is the sum of the 1,000. Okay, I cannot say that because it's wrong, because of the concept of the time value of money. So as I said before, $1 today is not the same as $1 tomorrow. So what do I have to do? What we previously done, which is to discount with a discounted rate. So I have the 1,000 in the 1 year at the end of 1 year, and I know that my opportunity cost is 10%. So I do the same I did in the previous slide. I divided the 1,000 by 1 plus the 10%. But in this time, as I have multiple periods, I power it to 1, okay? Because the first one its period is 1, okay? 1 year, after 1 year. So this 1,000 at present value is, the first 1,000 is 909. You see it? It's 909. And the last one, the 1,000 in the 5th year represents 621. How do I get to that number? By dividing the 1,000 by 1 plus the 10% at the power of 5, because it's period 5. Okay? This, if you understand this, you will understand valuation. Okay? This is why this is so important. So the numbers I have to compare to know what is convenient for me is the 3,500 from the beginning, the down payment, that was 500, with this 3,791. So I know that it's cheaper to download the cash, okay? It's cheaper than paying installments in $1,000, okay? Do you all understand? Yes, perfect. Silvia, I'm watching you, only you, so you say perfect. So let's talk about valuation. Unfortunately for you, we have to start with some theory, okay? I will try to be very, very light, but it's theory, at the end it's theory, okay? Because this theory will provide us the basis to understand all methodologies to value any asset. So at the end of the day, all methods, all of them, to value assets are based on calculating the future cash flows generated by an asset. For an asset, I mean a company. A company is an asset, or a project. All of this is an asset. So with the future cash flows generated by the asset, I will discount it at a risk rate adjusted. And how I'm going to adjust it? I'm going to adjust it depending on the industry, depending on the stage of the company. That means depending on the risk, okay? So there are there are a lot of ways of valuing a company, but we will focus on understanding two: the discounted cash flow and the valuation by multiples. Okay. Okay. We have three basic financial statements. Here we are watching at only two, okay? Because this is the summary of the summary of the summary. So I only need you to understand the income statement and the cash flow, but we also have the balance sheet, okay? Because the cash flow is a consequence of the income statement and the balance sheet. But the concepts that are important here to understand is, in general terms, that an income statement represents the revenues and the expenses that a company incur in a period of time. We always have when we value a company, we use years. So the income statement of an entire year, a fiscal year. And revenues and operating expenses are very important because they are the core of the core of the company. The revenues generated by the core of the company and the operating expenses that we have to incur to generate those revenues. So one minus the other gives me the operating income. In the JERG, we call it EBIT. EBIT means earning before interest and tax. It's not important, but it's important that it's an operating income. Then we have the cash flow. And I wanted here to relate the income statement with the cash flow. The cash flow is generated by the core of the operations of the business after deducting the free cash flow. Sorry, the free cash flow is the cash flow generated by the core of the operations of the business after deducting the investment in new capital. But to get to the free cash flow, I need the cash flow from operations that is born in the EBIT. As you see, the first that I put it in bold is EBIT, okay? It starts with the EBIT that comes from the income statement, and then I adjusted it by what I collect or what I debt, or my debts, my acreedores. I don't remember the word. Doesn't matter. Then this is how I get to my cash flow operations. And then I have the cash from investing, which are the capital expenditures needed to generate the cash from operations, okay? And then I get to my free cash flow. The free cash flow is the key measure of the cash flow to value the company, okay? Then this cash flow is a cash flow without considering how I finance my operations. What do I mean by that? If a company asks for debt to a bank, for example, or issue bonds, this is not going to be in the free cash flow. This goes in the financing cash flow. And if an equity holder invest money in a company, put money in a company, it's not in the free cash flow as well. It's in the financing. Okay, so I put a minus in the cash from financing, but it's a plus or minus, because if it has a lot of inflows in money, it will be positive, okay, to finance my free cash flow. This happens to all startups, that they need money because the free cash flow is negative, because they don't have revenues and they have a lot of expenses. So you have free cash flow negative, so you need money. So the cash from financing has to be positive in order to have a net change in cash balance at least of 0, okay? So saying that, which are like the more basics, we go to discounted cash flow. Let's go to some basic steps to make a discounted cash flow. First, we have to reorganize the financial statements. Why? Well, because the financial statements are accountancy, they look different, the financial statement, than we need to look at them, okay? We separate the operating items from the non-operating items. Sometimes the financial statements have the mixture, and we need to separate them in order to get to the previous, this slide, okay? In order to get it like this. So once I reorganize the financial statements, what we have to do? Well, we have to project the income statement. And when I project the income statement, I have to project the growth of the company. That is why it's so important, okay? And we see in these tech companies that are startups, or not that startups, but the growth are huge, okay? So we have to project all the income statement, not all of it, but at least up to the EBIT. What I mean, at least up to all that is operating, all that is the core of the company. Then we project the balance sheet and the free cash flow, because I will need the free cash flow. The free cash flow is the measure I will need to value the company, okay? Look, that you know that the most well-known technique is called discounted cash flow. So I need the free cash flow to discount it by a rate. Then what we have to do when we project is to put a stop in 1 year. When I am going to stop this projection, because it's not going to last forever. I'm not going to project until the year 1,000 years, sorry. So I'm going to project for 5 to 10 years. But when is the stop? Is when the company is stable. As you know, the companies you are used to watch are companies that they're stable. You don't know when they are going to be stable, because they are new, or they have, I don't know, 2, 3, 5 years. They are not stable, and you have no clue when they are going to be stable. So, but companies that are more stable, we can do it in a horizon of 5 to 10 years. It's not common to see it like more than 10 years. And what happened after that? Because the company is not going to die. So we need another measure to measure the value of the company. From that year, for example, if I say that the projection horizon is 10 years, I will need a value that incorporates the value of the company from the year 11 until infinity, until the end of the days, until the end of the world, okay? And that measure is called continuing value. Continuing value is something very important, because it doesn't matter the formula, okay? What it matters is the concept. The concept is that is the value of the company from the year 11th until eternity. So when companies are in high growth sectors, or new companies or startups, this value is almost all of the valuation of the company. Could be from 70% until 98%, okay? And when companies, we value companies that are from more stable, not high growth sectors, with more stable sectors or low growth sectors, this value is it could be between 40 and 50% of the total valuation, okay? So This is why it's important. We are not going to talk about this because it means a double click here that we don't want to do today. So what do we do with all this that we have? We have the projected free cash flow and we have the continuing value. So what do I do with that? I discount it with a discount rate. The discount rate to discount a company is called WACC. That means weighted average cost of capital. And it's the blended rates of returns required by the debt and the equity holders. We are not going to do a double click, although we are going to see it in an example later. But this can be a 2-hour meeting, so just to talk about the WACC. So we are not going to talk about the WACC. But yes, the concept. The concept is a discount rate that we saw at the beginning, like the 10% of the bank, like the 30% that you already said in the previous webinar that funds discount companies. So, sorry. I don't know what happened. I touched something here. Okay. Well, so just to sum up, an enterprise, and now we are entering with the concept of enterprise, discounted cash flow. Enterprise is firm, but the word we say when we go to look for listed companies, we say the word enterprise. The enterprise discounted cash flow needs. What do we do? We discount the free cash flow available, and remember that the free cash flow is the cash flow available for all the investors because it does not contain debt or equity, and we discount it at a weighted average cost of capital. So we have the enterprise. This is the discounted cash flow model, the one that you always talk about. So this is like the formula, okay? This means that the enterprise value is the sum of the free cash flows discounted at a rate plus the continuing value also discounted, because as I said, we look for a horizon. The horizon is if it's in the year 10, then my continuing value, I make it for the year 11. So this is what's called a perpetuity. It doesn't matter, but it's a perpetuity because it's a value for until the infinite. So I have also to discount it by the same rate I'm discounting the rest of the cash flow, okay? So here, what I want you to have in your minds is in a discounted cash flow, in a discounted cash flow valuation, the objective is to find the value of the assets. And by the assets, we mean the firms, the companies, given their cash flow, growth, and risk characteristics. These three words, cash flow, growth, and risk characteristics, are very important. So, this was very fast for something that is very complicated.
Yeah, that was so fast. Could we go back again to that one, please?
Yes, yes.
The last definition. Thank you.
Yeah.
So could you explain that again, please?
Yes. Okay.
Thank you.
I will explain, but it's better to go here. It's better to go here. You have to think that this was the example of the copier machine, and we had to choose between buying it today or buying it in 5 years. So forget about that example. Now imagine that these 1,000 are the cash flows for every year of a company. This is the free cash flow for a company of every year. So what do I do with these numbers? I just discount them and get to this number, to the 3,791. And then I add the continuing value, okay? And then I have the value of the entire company. That is the concept. What do I have here? Just this example shows you 1,000 every year, but in a real cash flow, you will see. This is a free cash flow, okay? So you will see 1,000, 5,000, minus 1,000, 2,000, and 3,000, okay? Because you invest money. So the free cash flow is, we have to sum the operating cash flow that is always, I mean, it has to be always higher every year because the company is growing, okay? So I have more revenues and I have more cash flow from operations, and then I have to invest money to get this cash flow. So that is the part where I can have my free cash flow negative, because I have to subtract a capital expenditure or any expenditure or the acquisition of a company in order to have those revenues, okay? So this is why the free cash flow could be negative. But if it's all positive, it's always the same, negative or positive, I just discount them and arrive to a present value of all futures value. And the only thing that is not here that I do is I estimate the continuum value, okay? You're not going to do that for your companies, because your companies are startups, are new companies. You're not going to do that, but it's important for you to understand the concept. So is it more clear now?
Yes, thank you.
Silvina, will you share afterwards the presentation?
Of course, it's for
Okay.
you.
Thank you.
Of course. So this is just because I love formulas, so this is why I put it here, sorry. I didn't mean to mess you. Okay, so we finished by discounted cash flow methodology, okay? The concept. The only thing that is important is for you to understand the concept, because multiples that are, I'm pretty sure that you are more used to listen to. For example, this company is three times revenues. This company is 2 times EBITDA. But these multiples, the origin of these multiples is a discounted cash flow, even though we don't do that math. We don't do the discounted cash flow. But every company first is measured by a discounted cash flow. So multiples are a derivation from the discounted cash flow. So this is why I wanted you to understand the origin of the discounted cash flow. So let's go to multiples. The objective in relative valuation is to value assets based upon, wait, because I don't see the presentation here. Based upon how similar assets are currently priced in the market, okay? So the previous valuation, I will go back because I want you to have that here. In discounted cash flow, the objective is to find the value of an asset given their own cash flows, their own growth, and their own risk characteristics, okay? Now we pass through multiple valuations. So in relative valuation, that are multiples, the objective is to value an asset based upon how similar assets are currently priced in the market, okay? So multiples are very easy to use, very easy, because as I said, you may have heard that 3 times revenue is a, I don't know, 9 times revenue is a SaaS company, for example. So it's very easy and intuitive, but it's very used as well. So there are 2 components to relative valuation. First, to value an asset on a relative valuation, prices have to be standardized. So we have to convert the prices into a multiple. That could be a multiple of earnings, of book values, or of sales. And then the second component is to look for similar firms. You know that it's very difficult because no 2 firms are identical. And firms, even though in the same business, can be different on risk, growth, and potential cash flow and cash flows. So this is not an easy task, okay? The key here is to understand how to control those differences. How I go on up to here? Yes? I can listen, Silvia.
You have an arrow abajo a la izquierda, hay unas flechas.
Yes.
Ahí va. Okay.
This one. Okay. Yes,
¿Avanzo?
yes. Go on. But no. I ask another thing. I ask if you are okay here. If I can go on. Yes.
Perfect. Go on, please. Sorry.
Okay. So what is the disadvantage? The disadvantage is that the strength of relative valuation is also its weakness. Okay. Because, well, there is a bias. Wait, no, I skipped one thing. Here. I skipped the most important, the reasons why relative valuation is so used, okay? valuations are based on based on multiples, and comparable firms need far fewer explicit assumptions. This is why it's very used, okay? We don't need to make so many explicit assumptions, and it's far more quickly than making a discounted cash flow valuation, which takes a lot of time. Then, relative valuation is simpler to understand. It's easier to present to clients, to investors, and to customers. And relative valuation is much more likely to reflect the current mood of the market, because I'm watching the market, okay? I'm watching how listed companies are valued today, because we have the valuations every day, okay? In the market, I mean, the listed companies.
Silvina,
So,
one question here from Marta. So, are there some typical multiples for each sector? You talked about SaaS, right?
Yes. Yes, there are. Yes, and I will go to that with an example.
Okay, perfect. Thank you.
A real example from real life.
Good.
So the strength of this relative valuation, as I said, is always weakness, because there is a bias in valuation, in any valuation, okay? In any valuation, there is a bias. And the lack of transparency regarding the underlying assumptions in relative valuation, think about what I said before. There are a lot of assumptions that are not explicit in relative valuation. This is why it's so easy to use. But if I don't have an explicit assumption, then this valuation is more vulnerable and to manipulation and to make a mistake, to commit a mistake. Yes, to make a mistake, sorry. So, the basic steps to using multiples. There are 3 basic steps to using multiples and detecting misuse, okay? The first step is to ensure that the multiple is defined consistently and measured uniformly across firms being compared. Now, in the example, in 3 or 4 slides, we have this example, and then we are going to see what it means. But you have to think that you need consistency between what you're going to measure. And the second step is to analyze the multiple and understand what fundamentals determine the multiple and how the changes in the fundamentals may change the multiple. This is also, I know it's like, maybe it's difficult to understand it, but when we see the example, it will be clearer. I will go back to this, okay? And then we have to find the right firms to use for comparison. Okay. Well, let's go to the determinants. Up to here, we already seen this, okay? We see that when we talk about discounted cash flow, we see that the value of a firm is a function of 3 variables. Its capacity to generate cash flows, its expected growth in the cash flows, and the uncertainty associated with the cash flows, okay? Every multiple is a function of the same 3 variables. It doesn't matter we are talking about a multiple. It's the function of these 3 variables. So firms, I will say this that is so obvious, but for you to digest it better, firms with higher growth rates, less risk, and greater cash flow generation potential should trade at higher multiples than firms with lower growth, higher risk, and less cash flow potential. So we can go back to simple discounted cash flow models and use them to derive multiples, because a multiple is a derivation of the cash flow, even though it's not the mathematics, the math is not so direct, but this is what I want to explain here. So, what is first, before watching or getting to the example, we have to ask ourselves, what is a comparable firm? A comparable firm is a similar firm to the firm being valued in cash flow, growth potential, and risk. So think about this. In this definition of what a comparable firm, I'm not talking about sectors. And previously I said, a SaaS company trades at 9 times revenue, okay? I'm doing the math with a sector, but here the definition of a comparable does not include the word sector. So it could be any company in the whole listed companies with similar cash flows, similar growth potential, and similar risk. But people who value companies, we have an implicit assumption, all of us, so it's always the same. Our implicit assumption is that firms in the same sector have similar risk, similar growth potential, and similar cash flow profiles. And they can be compared. This is why we always use the comparison in a sector. That doesn't mean that we don't...
Let me ask you something that came out, and I think it's the right moment. So do you think, when you say you compare about in different industries or in the same industry, what about regions? Because is it worthwhile to compare LATAM companies to companies from developed market like Silicon Valley?
Yes, of course, it's a very important question. I don't know if to go on and then answer it, because the answer is in the example. But what I want to say up to now is that when we look for comparables and we look for listed companies, in LATAM, we don't have many listed companies. We don't have a sample that is big enough in order to make this comparable. So we can't do that. That would be the ideal, but this is not what's happening. We always look for the market in the United States or Europe, but most of it in the United States. So we always have to adjust the multiples, and I don't want to say it before it comes the slide, but we adjust the multiples in order, because of the region, because of all of what you've said in your question, but it's not the same. But this is what we have to work for. We have the material we have are the listed companies in the United States, most in the United States. So we look for there we have a lot of companies. So the sample could be greater, okay? So, well, yes, it's here. I didn't remember that it's in this same slide where it says that we need to adjust the multiple to account for the difference to the selected peers, okay? I know you're looking for the example, but if I don't say the theory first, the example is not worth it, okay?
Perfect, so, go on.
Okay, sorry. I know this is not something so nice for a Friday evening, but well, I like it. Okay, so let's go to revenue multiples. A revenue multiple measures the value of a business relative to the revenue it generates, or it will generate, okay? Because we talk about the future. The biggest disadvantage is that it can make you assigning high values to firms that are generating high revenue growth while losing money. That we are going to see it as well in the example, okay? This is a disadvantage. So this is so important to analyze the companies you are using to compare your company to. That is like the key, okay? So you have to control this difference. And to control this difference, you have to analyze the companies you are using to measure, to get your multiple, your final multiple. So another formula. I swear it's very easy. The enterprise value to sales ratio. This is the ratio when we say that a SaaS company trades at 9 times revenue. What do we say? We say that the enterprise value of the company divided by the revenues is 9 times. And how do I know that? Because of the listed companies. I don't imagine that number. I just go to the listed companies and I see all the SaaS companies, and then I do the math for all the listed companies, and I arrive to the conclusion that the average or the median, that is, we use the median really more, is 9 times revenue. We don't pick one, we pick a sample, okay? So, this one I'm going to pass it through because it's Friday night. And I don't know the time, but yes, better. This is part of the example. Here is, the example starts here. This is real life, okay? We did a valuation on February of this year. We finished the valuation on February of this year of an e-commerce company. So we look for different e-commerce listed companies, and we selected these firms. We look a lot of more companies, but we have to understand first the companies that are more comparable to the company, the business that the company that we were valuing, okay? And we differentiated into 3 sectors. The e-commerce enablers. Why? Because the company I was valuing has a part of e-commerce enablers. I mean, it's not that simple that a company is only one business and you just match this business with the listed one. You have to adapt it, okay? And we divide the revenue of this company into 2, into e-commerce enablers and e-commerce. So here we have 3 groups. The clothing e-commerce B2C, because in the States we have so many listed companies that we could do that, and then the e-commerce itself and the enablers. Now look what we can get from the listed companies. We get this. For example, let's go to Shopify, okay? Shopify, the ticker at which it trades is shop, the currency is dollars, the market capitalization is this number, it doesn't matter. The EV is the enterprise value, which was the formula I said that it was simple. The enterprise value to sales ratio is the enterprise value divided by the revenue. So I have this data from the listed company. And then I have the previous financial statement. So I have the revenues, okay? So I divide, what I do, my math is dividing this enterprise value by the revenue, and I get this number. Let's see if I mark, do you see the point, the red point? Can you see it? Perfect. So I do the math myself, because this 25.7 times is not from the, you can see that in the data you get from the listed companies, okay? You receive this data and the revenue. The financial statement really, not the revenue, not only the revenue, the financial statement. What do I do with that? Well, I transform it into enterprise divided by revenue to the ratio I want to measure. And then I also always do this, the enterprise valuation divided by the EBITDA, which is the operating margin before the depreciation and amortization. But look what happened here. I don't have numbers. What does it mean? These companies are negative, except this one, except the one that is 31.5. So this is why it's very important to understand the value, because if I say that these companies are 25.7 times revenue, it's wrong. It's not only one. So I have to understand what's going on here. Well, all these 3 columns, we made this column. We do the math to get these 3 columns, okay? Because I have the data. So I know that Shopify, for example, that trades at 25.7 times revenue, has a KGR, which is the compound annual growth rate for the last 3 years in revenues of 74%. And look at the other that is behind that, it's minus 10%. So of course they are going to trade at different prices. So I have to understand all this in order not to make mistakes in my valuation. But mistakes, errors, it's impossible not to make, because it's a lot of data. To get this is the conclusion of a lot of companies that we analyze in order to use these, the ones that you are watching here, okay? So we analyze one by one. And then what do we get? Well, that the e-commerce enables the median of the enterprise value divided by revenue. So the revenue multiple, the median is 1.3 and the average is 7.2. Look that the average is very high respect to the median because of this 25.7. So when we say that this can lead you to make mistakes, but the bias, when we talk about the bias of these multiples, the bias one bias could be that I manipulate the numbers. I can manipulate the numbers. I can take it out, or I can use less, or I can use the average, okay? So it's very important who is analyzing the company, the experience, the knowledge, and if this person wants to manipulate the numbers or not. So when you hear a number, you always have to be careful. You have to take it into brackets, in between inverted commas, okay? And then what did we do with all this information? We had here we had a general median and average out of all of the companies, all of these companies. We have that the median is 1.8 and the average is 4.5. Okay, perfect. And now we have the company parameters. Our company's revenues were, we did that at the beginning of the year, okay, was $5.2 million. And in the year 2023, it was going, the revenues were 12.6. We don't look at only these numbers, okay? We look at the whole company numbers. This is what I'm going to take to evaluate the company, but the same. I watch this 13% growing in growth, in 2020, and this KGR, this compound annual growth rate that is for 4 years between 2019 to 2023. This is how the company is going to behave. Then the first valuation we do is the valuation by comparable companies. I want to go this here, by comparable companies. Okay. So what do I have here? I have first the market multiples, what we saw in the previous one, in the comparison, okay? We got to this median 1.8 with this average 4.5, and this estimate, punctual estimate, which was between those, which was the neighbors, I think it was the neighbors, yes. No, it was the clothing e-commerce B2C, that it was 2.7. So we use that, we use it as an estimate, punctual estimate. Sorry. And then we adjust those numbers. How do we adjust them? By the liquidity premium, because of the question you asked, Sylvia, 5 minutes before, how do we manage with visions? Well, here are two things. First, the liquidity is because the companies we are comparing to, the listed companies are liquid, because I can go to the stock market, buy and sell in one moment. And the companies we are valuing here, they don't have that liquidity. So how do we know that 25% is the liquidity premium? I'm going to punish this multiple by a 25%. How do I know that number? Well, liquidity premiums are based on historical average for companies, from companies that trade versus companies, private companies. And there are a lot of research about it. We took, for example, here, we use the Damodaran liquidity risk premium, which is like very well known, okay? And then we have the Argentine premium. How do we know the Argentine premium? That is, what do we do to have that current number? This is like a current premium. Why? Because we went to the listed banks, Argentine banks, and we compared them, not one, like 3 or 4. I think we did it with 4. And we compared them with banks that were listed as well, but banks from the United States. And then when you have, well, we compared the book value to these valuations, and then we got this Argentine premium by the differences. Why we use banks? And because banks, the business of a bank, are the most homogeneous businesses we can compare, okay? Because banks do almost all of them do the same. So this is why we use banks. And the book value of a bank is a more current value than any company. Because in any company, in different companies, we don't use the book value. But here in banks, we can use it, okay? So this is how we get to this adjusted premium. And then this 1.8 is transformed at 0.9 times, okay? So a listed company in the United States trades at 1.8, by the median is 1.8. But here, our company, that is all revenues are in Argentina, we will use the 0.9 times revenues. So as we use the median, the average and the estimate, so we have these different adjusted multiples and this first valuation range. What do we do in evaluation? We just triangle different values, because evaluation is not just a number. It's not that I say this company is valued this number because I did this fast. It's not like that. We triangle a lot of different values and we do sensitive analysis to triangle these numbers, okay? So this is the first step. Then let's go to the second step. The second step, as you saw, we have segments. We value it by the 2 segments that this company has. Remember that we divided the 5.2, wait, I didn't say how did I get to the 4.5. How did I get to this valuation range? I multiply the revenue of 2019, remember that we did it at the beginning of this year, so we multiply the 5.2 by the 0.9, okay? If the math is not exactly, it's because these numbers had a lot of numbers after the comma, or the point, it's a point, not a comma, it's 4.5, okay? So, then I value it by the segments. And then I arrived to a valuation range. I do the same. I use the e-commerce market multiples. These that are in blue are the markets that we saw in the first slide of this example. And then I multiply by the same revenue number, okay? 4.3 and 11.4. And then we use, particularly in this valuation, we use the VC method. This is one of the VC methods. VCs have a lot of different methods, okay? This is one like common method or more theoretical method, okay? So here we used this market multiple, the punctual estimation of 2.7, and then we reduce it by the liquidity premium. The liquidity premium must be all the time, okay? Because this company is not liquid. So I arrived to this 2 times revenue new multiple. And then, as we saw in the beginning of this example, the revenue of 2023 is going to be 12.6. So if I multiply these 2 by 12.6, I will arrive to this 26. But what's happening with that 26? This is not a present value. This is a future value. This is the value that the company will have in 2023. So what do I have to do? What we saw in the second slide, we have to discount it up to today to make this number into a present value. How do I do that? Well, that is not as easy as I just discount it at a 30%, at 10%. We have to construct, I'm sorry. We have to construct that number. How do I construct that number? Well, it's, I'm listening like retorno. Do you hear it as well?
There is a little bit of echo, but I think it's okay.
Okay. Well, so what do we have to do? We have to obtain this rate. How do we do it? Well, here in this example, this rate is the cost of equity. I mean, it's not just an example. This is real life, a real company, okay? Here, this cost of capital that I said it was called the WACC, which is the weighted average cost of capital, which blends the cost of capital of the equity holders and the debt holders. But here, the company doesn't have debt. So we only use the cost of equity. And this is another important issue that we are not going to do a double click because we don't have time in an hour to all of the theory, okay? But this is made by a model that is called the capital asset pricing model. This is what we use here. And we get to this 20%. But look what we did. We did 3 scenarios here with the same numbers, with the same adjusted multiple, and the same revenue. And going back to the question that Silvia did to me, she asked, is it the same, a company in Latam than in the States? No, it's not the same. So here, the example is with Argentine equity risk premium, okay, and the mature equity risk premium. But this number that changes, which is the Argentine equity risk premium, is what differentiates a Latin American company from a developed country, because it's not only to be, it doesn't have to be just the States. It could be Germany, or it could be the European Union, okay? We use the States because almost all of the tech companies are listed there. So by this, adjusting the multiple with this last number, you turn this multiple that is from a liquid United States company into a LATAM company. So here is Argentina, but if the company has revenues in different countries, you have to make an average of this, not an average, weighted average of all the risk in the different countries the company has. So imagine how difficult it is to do that when you sell in a lot of countries, and when the revenues that you have this year are going to be very different in 5 years, for example. Imagine that this year you are in Argentina, you sell in Argentina and in Brazil, but you plan to sell in 5 years in Europe. How do you measure this? This is why the multiples, and not this method that we use here, but this is why the multiples are very easy to use, because you don't have to do that math, okay? And discussing that can take you forever. So you don't want to discuss that, because you don't know what's going to happen. You don't know if you are going to fulfill what you think you are going to fulfill as an entrepreneur. So, and the venture capital doesn't want to take that risk. So we don't do that in startups, okay? But it's important to understand that this exists, because these 26, but what does exist in a startup is that when, for example, a startup fund says, well, I'm not going to put a valuation now and I'm going to invest in your company, but I'm going to put a valuation in the valuation will be in the future, okay? Will be in the future. Once you have another funding round, and your company is more established and we can see something, because today you are a PowerPoint, or today you are only an MVP, okay? We can't see anything. It's all a PowerPoint and an Excel. So this is this future value is what they bring today by any discounted cash flow, because any discounted, the discount rate that this fund uses, which is not 20%. This is very, very little for a fund, okay? Funds tend to discount at 50, at 40, 30. 30 is, well, for Argentina it's very low, but 40, 50, okay? So what do we do here? We just do different scenarios, because Argentina has a debt that is very risky. So we do scenarios taking into account that risk at different levels of risk. For example, the scenario 1 is with a debt valued at B2, the different valuations of the debt, okay? If we are about to default, is the last one. So the equity risk premium is at 22%. And this one is between having a good debt, behaving well, paying, and let's say paying and the default. This one is in the middle. And we also obtain that. We don't invent the number. We go to this research, and here we use Damodaran because it's the most well-known. So we are nobody's going to discuss this number because it's public also. And then we discount this number, the 26, in the 3 different scenarios by the discounted rate, as we saw in the example of the beginning. So what did we do? We divide the 26 by 1 plus the cost of equity, that in the first case was 20, in the second 28, and in the third 39, at the power of 4, because the years of the revenue, because the revenue of 23 is 4 years from today. So I take the future value into today. And then I go to this another range of valuation, okay?
Silvina,
So,
sorry, how much time do you need? Because there are some questions and we want to make sure that you will answer some of the questions.
this slide and the next one are the last ones.
Thank you.
So what do we do with all of that different valuations that we have? We put it in a graph. Here, this graph is the real graph we presented to the company, and it includes two things that I didn't show. The first one is the first one we see here are the comparable transactions. We also look for comparable transactions from companies that are not listed and that we have the information, because when a company is not listed, it's not obliged to do the disclosure of the information. So maybe we have, I don't know, 50 transactions, but we don't have the information. So here for this company, we got like 5, and it was a lot of transactions with the information we needed in order to adjust the multiples. We did the same procedure. We adjust the multiples, and then we apply them to the revenues of this company. But here we also have to take into account the control premium. This is another premium I haven't talked about because the other companies didn't have that. But when you buy a company, for example, and when you buy a part of a company, if you are going to have the control, maybe you want to pay for that control. So we adjust the multiple that gives these comparable transactions, and we take into account that controlling premium as well. And then we go to these valuations. Look, they were very high, okay? But then the VC method and the VC method, we did 2 sensitive analyses, one with the revenues and one with the multiples. So we do a lot of sensitivity analysis, and we choose like the ones that are in the middle, that the middle is the revenue that the company already has, or the 23 revenue, this is like the middle, and we make a sensitive analysis, think that, well, what's happened, it is less than this number, and it is a little more than this number. And then with the multiples, we do the same. We start with the multiple that we already see, and then we say, okay, what if the multiple would be is less than that, and it's a little more. And then we obtain a new range. So with these new 2 ranges, and then what the first valuations we saw, the global that we did only with the median and the average, with only one number. And then when we divided it by segments, we have all this. And then we look at this, we take into account the companies we measured our company to, and then we look at our company and say, okay, the range valuation for your company is between 8 and 10. The median of all these values is 9.5, okay, which is this line. This line is the one that is 9.5. But we don't say a number, we say a range, because evaluation is never a number, it's always a range. And what does that range mean? It means that if a fund says, well, this company is worth 6 million, it's not. If it's less than 8, it's undervalued. And if it's more than 10, it's overvalued, okay? This is what the range means. So you start by, it's all about a negotiation, okay? You start negotiating, but we have like from where to start, okay? So this is the end of the example, and I don't know if you have a question about the example, sorry. About the example? No. Well, I promise this is the last one, okay? I'm sorry. How do we value early stage startups? There are 2 ways. One is the rule of thumb. What is the rule of thumb? A company in a market where you have a lot of investors and you have a lot of projects, like for example, California, Silicon Valley, VCs or funds have like this, they say, okay, an idea, a PowerPoint of new entrepreneurs is worth $500,000. But the same idea, the same PowerPoint and the same Excel with entrepreneurs with more experience is worth $2 million. This is the rule of thumb they use because they don't have anything to grab with, okay? So that could happen in mature markets where there is a lot of money, a lot of funds, and developed countries. The same idea with the same entrepreneurs, but in LATAM is not the same, okay? So funds here, what the funds here try to do, as they don't know where to grab with, because the risk that we have in our countries, and in Argentina more than anyone, the risks that we have are so high that you cannot value that. So what does funds do? What do funds do? Well, they found another way. They say, okay, I will invest in you, but the valuation, we won't put the valuation today. We put the valuation in the future when you have something real to be valued and when you go to the next round with a valuation, okay? So this is why it exists what is called the hybrids, which are instruments, different instruments that is not a debt and it's not an equity. It's called an hybrid, that someday it will turn into debt or to equity, but today it's an hybrid. I will see what happened with your company because I don't know if I want to be an equity holder of your company. I have to see first what's going on with you. So this is what I can say, but it doesn't matter that you're a startup. The number that you will put, if you put a number, this 2 million of the example or 500,000, it's always what they think about is the future, and future cash flows bring today the present value. That is the key concept that you have to understand. Well, that's it.
Thank you very much. It's very, very useful. Everything is great. So first, noblesse oblige, the great question that I did about LATAM and US was Susana's question, not mine, okay? So that's why it was such a smart question. And then Marta asks another smart question is, when startups give a very large discount rate, what signal does the startup give to investors?
What signal did the
startup give to investors?
You said need?
Give to investors.
I didn't understand the word.
Marta, do you want to explain it?
Yes.
No, not explain the word. I can't hear the word.
Give, con G, give.
Okay. Dar.
Okay, I got it. So the question is, when a startup has a very large
discount rate, what signal does the startup give to investors?
You mean that the startup gives the investor, if the startup gives the investor
yes. Sometimes the startup has offered to the investor a very big discount rate. And it's important to understand what is the signal that the startup give to the investor, because it's like I am very, very desperate for the money.
Yes, of course. Well, maybe you have to, like, as we say in Spanish, rascar a little bit to understand that. You have to dig in the company, with entrepreneurs, because it could be that they are desperate because they don't have money, and if they run out of money, they cannot go on. So that could be one question, and it doesn't matter that they may be very good. So you don't have to think that because they are desperate, this is all bad. Because we are in LATAM, okay? We are not the state. We don't just open a door and we have millions of dollars of funds. So you don't have to discard a project because of that, or think, oh, they may be not that good, because if not, they would have got another more funding. Mm-hmm. So you have to dig why. You have to understand first, as you know, that founders, the team is very important, that they are solid or with experience. Or if they don't have experience, well, that's the signal. I don't have experience. I'm going to experience with your money because I don't have that experience. Okay, so this is why You have to ask a lot of things. And it doesn't mean that it's a bad project, or it doesn't mean that it's going to fail. No, not at all. But we are in Latam. When I started working here in Argentina, I worked for abroad 20 years, okay? So when I started working for Argentina, I just like fell in another reality. We don't have money here. What is $10 million, 2 million, 5 million abroad, it's nothing. When I came here, I said, well, that is nothing. And then I fell on the floor, and I got that I was in Argentina, and that was a lot of money, and very few people get this money. Okay, so that would be my recommendation, to dig on the entrepreneurs if they are desperate because they don't have a clue what to do, because nobody wanted to put money because of something like that, or because there is no money and they are desperate to go on.
Mm-hmm. Okay, thank
Imagine
you.
if that happens in Argentina, what happens in Uruguay? Right?
Well, it's in the whole Latin American countries, in fact.
Of course. Yes.
Maybe not Mexico, that is in best situation.
Or Brazil.
Or Brazil.
Mm.
Yes.
Silvina,
Okay, any more questions?
I have a question. Silvina, for those of us that do not come from a numbers background, what do you think we can read or we can listen to, whatever, to give more meat to your presentation? Well,
if you want theory, I can share with you when I send you this presentation.
Like Valuation for Dummies, that's what we need.
Yes, something Valuation for Dummies, or I can include I can add another slide with books you can read.
Thank you so much.
And then a useful thing that I did when I started valuing tech companies, I follow a lot of, I follow some well-known analysts from funds abroad that in very, maybe easier than I explained, because I explained a lot of theory, okay? But with these rules, with these like elements, concepts that you have, and if you read these guys, you will understand a little more. I can also add the names the ones I follow, okay? The links. And then you subscribe to the webpage, and they send you information almost every 2 days.
Great, thank you.
Okay, well, I think it was great. Paso a español. Excelente, excelente, Silvina. La verdad que sí, aplauso total porque viernes a esta hora, recién en este instante se empezaron a bajar algunas.
Muy
maravilloso.
Muy poquitas, solo 3. Ah, no, 5.
Muy poquitas.
Sí.
Todas, porque todas tienen que hacer otra cosa, así son.
Sí. Ahí dejé un mensajito para todas, pero lo leo por las dudas que no lo lean. El próximo webinar que planeamos es el de legales, para ver lo que tiene que ver con documentos, para perfeccionar la inversión, y vamos a volver sobre la parte de tasa de descuento y la parte de cap de evaluación. Silvina, obviamente estás invitada, si querés participar, te pasaremos la fecha.
Muchas gracias.
Excelente, la verdad que beyond expectations, que ya eran altas, así que...
I have to read theory again, girls.
Muy bueno, nos hiciste pensar mucho.
Because the biggest mistake that if a manager investing in a company or any investor can do is to enter at a higher valuation than he or she should. So understanding valuation is key. So,
and it's also an art, you know, it's finance, it's numbers, but it has a lot of art.
Yeah.
It's art, experience, knowledge, the three together. Yeah. Because if you have experience, knowledge, and you don't have art, you see only just the cool numbers, it's not worth it, okay? It's not worth it. No. Don't do that.
Yeah.
It's a mixture of things.
Right.
Yeah. Absolutely.
Okay, great. Thank you so much, Silvina. Very nice to meet you.
Thank you for inviting me. I feel very honored. I'm very happy that you like it.
Bye.
Juan, thank you so much.
Thank you.
Bye.
Thank you.
Bye.
Don't forget the picture.
Oh, yeah.
Oh.
Ah, yeah.
Susana, you are the expert. Please.
Oh, no. Okay, but I have people that, hold on.
Pongan las cámaras.
Yeah, get the cameras going. But today I